A very good morning to everyone. My name is Omkar, and today my team and I are going to walk you through the green initiatives that we have planned to implement in the region Al Wakra, which is based in Qatar. So, going about the region and initiative, the country we've chosen is Qatar. The region specifically is Al Wakra in the southwest, and we've written six initiatives, which the six of my team members will talk you through. So why Al Wakra? The first reason was as Qatar was one of the fastest growing cities south of Doha. So we thought that the major ongoing developments like residential, sports, cultural, and commercial projects are something that would give us a more comprehensive pathway to work on, and it would be more feasible for us to implement these initiatives on a big scale. At the same time, it is strategically aligned with Qatar's National Vision 2030 and SDG targets. So it would just make it even more feasible for us to go ahead with the initiatives. The company that we've chosen in focus is called Al Barwa Real Estate. Uh, One of the reasons we chose this company was because it had a lot of transparent financial data, which was verifiable and auditable by the team when we did the research on our companies. Secondly, it was the master developer that was actively operating in the Al Wakra region. So what that really indicated to us was that they had presence in the Al Wakra region. People knew about them, so there was more credibility as well. Third one being it's the most directly relevant real estate company that is said to be there based in Qatar. So this initiative would not just be a normal one, but something that would give it a generic benchmark. And the fifth one being that, like I mentioned, it's strategically aligned with Qatar's national vision, their 2030 and SDG targets. So this would make it even more easier for us to implement policies and the ideas that we had.
Hi, my name is Vibhav, and my initiative is Water Shut-off Waves and Alternative Use. The city we have to choose is Al Wakra. Country is Qatar. Al Wakra Municipality, Qatar. It's a 25 years project horizon. Qatar faces mounting pressure on freshwater resources and urban population grow and climate demand increase. Al Wakra is one of the Qatar's fastest growing municipality. Is unlikely to position to lead a sustainable water management. This initiative combines smart leak detection technology with grey water reuse system to reduce the consumption of by 30%, lowering operational cost and cut carbon emissions over 25 years, directly supporting Qatar National Vision 2030. Current challenge and baseline scenarios. Without the intervention of Al Wakra water system, compounding pressures and baseline scenarios, continuing the business as usual projects annual consumption 1.2 million meter square and operating cost of $2.64 million per year with the demanding rising and population growth. Baseline matrix. Annual consumption is around 1.2, savings is 30% and annual water cost is a 2.64 million and the project life is 25 years. The key challenges that we face is water leakage, growing population, wastage, and proposed initiatives. Two complementary solutions: alternative water uses. Grey waters from sink, showers, and laundries captured and filtered and redirected. Landscape irrigations and non-potable uses, reducing the reliances on treatment of fresh waters for routine appliances. Water shut-off waves. Automated waves equipped with flow sensors detect abnormal and shut off water during leak events, preventing before cut-off, a very costly problem. Project assumptions. The financial project is based on the conservative market aligned assumptions. The weighted average cost WACC of 6.05 reflects a blended cost of equity and debt market premium applied to the debt, reducing the borrowing cost of environmental beneficial project items such as like project life CPI. Project life is 25 years, CPI is 2.5, inflation. WACC is around 6.5. Tax rate, which is the average in Qatar, is about 10%. The initial capex is 4.5%. All the components are like equity. We have taken equity. I have taken equity weight of 35%, debt equity of 65%, cost of equity about 9.10, cost of debt is 5.075, and the final WACC is 6.05. Financial results and investment returns. Over 25 years project life, the initiative generates growing operational savings and significant outspace costs. Annual savings rise from 792,000 in 2026 over 1.43 million by 2050, driven by inflation adjusted water cost reductions and compounding gains. So as you can see, the operating cost is 792k by 2030. It's 874k, and it's now 1.12 million by 2040, and by 2050 it's 1.43 million. And the NPV of this project is like about 7.6 million. Strong positive value over 25 years, 18.35, nearly 3x of the WACC, and the payback time is 5.68. Full capacity recovery under 6 years, and IRR is 18.34 versus the WACC is 6.05, which confirms that the project creates a sustainable value over every dollar invested. Environmental impact and carbon abandonment. Water and energy deeply connected in Qatar. So the BOA emissions and the initiative emissions from 2026 is BOA emissions is basically 5.2k, initiative emissions is 3.75k, which has increased in 2035 around 4.68k, and BA emission is 6.5k, and in 2025 it's 2050 it's 6.78k, and BOA emissions is 9.41k. Environmental benefits: it's lower the water demand, reduced energy uses, carbon amendments, savings from 150 ton carbon in 2026 to 2624 ton carbon emission by 2050. Long-term sustainability. MAC analysis and sensitivity analysis. So as you can see, in sensitivity analysis, water savings as lowest as possible is 20%, the base is 30%, and the highest possible is 40%. WACC is lowest as 5%, base is 6.05%, and highest it can go to 8%. Capex 3.6 million, base is 4.4 million, and highest it can go to 5.4 million. MAC results 4.26 per dollar per dollar for per ton carbon emitted. Recommended proceeds with implementation, financial viable, environmental beneficial, fast payback, supports Qatar visions by 2030. So this is the appendix part in which I have showed that how I have calculated all things. This is the WACC assumptions. Now you can see the project basic assumptions, and this is the baseline data which we have all contributed according to us. This is the sum of all. This is public realm. This is amphitheater, cinematic art complex, global culinary arts center, which we have calculated till 2088 according to our 2093 according to our usage. And my initiative, particularly my is initiative 1, I have calculated till 2050, as my project lasts only for 25 years, BAU, counterfeit CO2 emissions, capex, and everything. And in the sense, this is the sensitivity analysis, impact on NPV, impact high, low, moderate. According to that, everything is here.
Hello, my name is Muhammad Ali, and my initiative is solar PV and rooftop integration for Al Wakra Southwest. I built a 25-year model to test whether covering development in solar makes sense for carbon and for cost. So the challenge is that Qatar's grid runs on natural gas, so every kilowatt hour carries 0.49 kilograms of CO2. Al Wakra Southwest will use over 800 million kilowatt a year when it's done, but Qatar also has one of the best sunlight. It's 2100 kilowatt hour per square meter. So a high carbon grid under an excellent solar resource. That's the opportunity. So my proposal is a 50 megawatt rooftop and canopy system covering about 10% of demand. It generates most when ACs are at peak, displacing the dirtiest grid power. So for year one, we'll have 80 million kilowatt hour of clean energy, 39,000 tons of CO2 avoided. So we used our official baseline data for the whole development. Demand starts at 801.2 gigawatt hours in 2026 and passes over 1,000 by 2050. That's the do nothing case our solar is measured against. So the sizing is grounded in real numbers. Qatar's irradiance a 76% performance ratio for dust and heat, giving 80 gigawatt hours in year one, and it declines 0.5% annually as the panels age. So to value it, I discount future cash flows using a WACC built from Al Barwa Real Estate. That's a real Qatari market benchmark with a 9.2% cost of equity, 6.2% cost of debt, zero corporate tax, and a small green financing discount. So the total WACC comes to 7.85%. So over the 25 years, the project abates about 925,000 tons of CO2. The net present cost is $38.7 million, and that gives a total MAC of $42 per ton. Now that's a positive cost, and payback exceeds 25 years, but that's because Qatar's electricity is heavily subsidized at 13 Qatari Riyal a kilowatt hour. So the carbon savings are real. The gap is a subsidy problem, not a project problem. Now, lastly, recommendations. My recommendation is to proceed now as an anchor sustainability asset. It secures GSAS green building credits, aligns with Qatar National Vision 2030, and hedges against rising tariffs. And lastly, we revisit expansion by 2030 if tariffs rise or a carbon price emerges. Thank you.
My initiative is Walkable City and Micromobility. The initiative aims to provide people with a convenient and sustainable low-carbon alternative to traditional vehicle use, particularly for short-distance journeys, reducing congestion and lowering carbon emissions. We can see current transport inefficiencies, congestion, and high pollution highlight the need for more sustainable mobility solutions. The obstacle is that vehicle emissions cannot be eliminated right away, and implementation requires significant planning for such an initiative. The data for the initiative was collected by looking at existing projects in the Gulf region on a similar scale, allowing for a rough estimate of feasibility while ensuring our assumptions are grounded in facts and not speculation. Data was collected from research papers, government reports, and open data sources. Where local data was unavailable, Qatar national datasets were used and scaled to Al Wakra. Similar Gulf projects were used to benchmark costs, and financial modeling was used to calculate capex, opex, carbon abatement, NPV, and MAC. Carbon emissions were calculated from electricity use, vehicle travel, fuel consumption, and cooling demand. Grid electricity emissions were estimated using Qatar's carbon grid factor of 0.00461 tons of carbon per kilowatt hour, while renewable energy was assumed to supply half of total electricity needs. Combining these factors gave the counterfactual emissions, and the initiative is expected to reduce emissions by up to 20% over 5 years. To estimate business as usual capex, we identified the required infrastructure, benchmark costs against similar GCC projects, and applied unit prices and asset quantities based on the project build-out area to calculate the counterfactual capex. Initiative capex was estimated by allocating the total build-out area across bike lanes, green spaces, lighting, and cost assumptions were benchmarked against similar projects in the region and applied on a cost per square meter basis. Walkable City initiative has a capex of around 368 million Qatari riyals compared to about 99 million riyals in the counterfactual, resulting in a net cost of 268 million. OPEX was calculated by applying maintenance costs to key infrastructure assets, including roads, road signs, ramps. The counterfactual OPEX is estimated to come out at 805,000 riyal, while the initiative OPEX is estimated to come out at 384,000 riyal, resulting in net OPEX cost savings of about 420,000 riyal. The marginal abatement cost of 1,480 Qatari riyal per ton of carbon dioxide means that for each ton, emissions are reduced through our initiative. This means the cost to prevent 1 ton of carbon emissions is 1,480 Qatari riyal. These figures allow us to better understand the cost effectiveness of our initiative of a walkable city. The initiative produces almost 12,000 tons in 2026 and remains mostly the same. Abatement is 405,000 tons of carbon dioxide in 2026, increasing to about 500,000 tons by 2031. The counterfactual capex remained largely unchanged, while the initiative capex was estimated at approximately 36 million Qatari riyal. This was calculated by estimating the required number of e-scooters and e-bikes using the population and an assumed 5% adoption rate, then applying market unit costs. As a result, the initiative delivers net capex savings of approximately 64 million Qatari riyal by replacing traditional transport infrastructure with lower cost solutions. Counterfactual OPEX was estimated at 1.2 million Qatari riyal compared to 6.6 million Qatari riyal for the initiative. Initiative OPEX was based on maintenance costs for e-scooters and e-bikes, including battery replacement every 4 years, resulting in higher operating costs than the BAU OPEX. The marginal abatement cost of 157 Qatari riyal per ton of CO2 means that for each ton of CO2, emissions are reduced through our initiative of micromobility. This means the cost to prevent 1 ton of carbon emissions is 157 Qatari riyal. This significantly lower abatement cost shows high efficiency in reducing carbon footprint despite high initial investment costs. To conclude, Initiative 2 is cost effective, reducing costs and reducing emissions. Even though Initiative 1 is more costly per ton of CO2, it provides long-term infrastructure benefits in urban mobility. This shift to sustainable transport and renewable energy optimizes costs and reduces emissions.
Right, so I'll be presenting my sustainability initiative for Al Wakhra, which is district cooling. Basically, district cooling is a centralized cooling system where one large plant produces chilled water and distributes it to multiple buildings through underground pipes, replacing individual air conditioning units. In this presentation, I'll briefly explain how the system works, the key assumptions behind the project, and the environmental and financial impacts, and also why it can contribute to a more sustainable future for Qatar. First, let me explain the project. District cooling is a more efficient cooling system than traditional air conditioning because one central plant can cool many buildings while using much less electricity. For example, in a project, the district cooling system has a coefficient of performance or a COP of 5.5% compared to 2.8 for conventional air conditioning systems. This means that it can provide the same cooling while using around 49% less energy. The project is planned over a 25-year period from 2026 to 2050. It will gradually expand from 40% network coverage to 90% over the first 10 years. The total investment includes 48 million Qatari riyal initially, another 32 million Qatari riyal in the second year, and a 15 million Qatari riyal upgrade in 2038. Now I'll discuss the financing of the project. To evaluate the investment, I calculated the weighted average cost of capital or WACC, which is the discount rate used to value future cash flows. So I used Barwa. We basically used as a group Barwa Real Estate as a benchmark because it is one of Qatar's largest property developers. After considering the benefits of green financing, the project's WACC is 7.85%, which is slightly lower than conventional financing due to the green bond advantage. Next, we'll look at the environmental impact. One of the biggest advantages of district cooling is reducing carbon emissions, since Qatar mainly generates electricity from natural gas. Using less electricity directly lowers CO2 emissions. Over the 25-year project life, district cooling is expected to reduce emissions by approximately 958,842 tons of CO2, which is close to 1 million tons. Another important benefit is reducing refrigerant leaks. Um, Traditional air conditioning systems have a leak rate of around 15%, while district cooling reduces this to only 2%, creating additional environmental benefits.
Now, moving on to the financial performance of the project. The project requires a large investment during the first 2 years, which explain the sharp increase in the cost at the beginning. Operating savings start to outweigh additional operating costs from 2029 onwards, but because of the high upfront cost and the major upgrade required in 2038, the project does not recover all of the cost within the 25-year period. The project has a net present value of negative 62.6 million Qatari riyal and a payback period of more than 25 years. However, the marginal abatement cost or MAC is around USD 45.6 per ton of CO2, which is within current voluntary carbon market prices. This suggests that the project achieves carbon reductions at a reasonable cost. To conclude, district cooling may not fully pay for itself through financial savings alone, but it provides significant environmental and long-term sustainability benefits. The key outcomes of the projects are around 49% energy savings compared to conventional cooling systems, nearly 959,000 tons of CO2 emissions avoided for over 25 years, operating savings beginning from the fourth year, competitive green financing with a WACC of 7.85%. It also gives a strong support for Qatar National Vision 2030 and its energy efficiency goals. So overall, district cooling is a long-term sustainable infrastructure investment that reduces energy consumption and carbon emissions while supporting Qatar's future environmental targets.
I'll be walking you through the passive design and thermal installation initiative, and this would evaluate whether the installation retrofits in Al Wakra are financially viable rather than treating sustainability as a cost. The objective is to determine whether or not reducing energy consumption creates sufficient cash flow to justify the upfront investment. So moving to the next part, the project retrofits 500 buildings, 350 residential, over 150 commercial, and the timeline is between 2025 to 2031, with a 10% pilot before full deployment. The investment case is based on Barwa's passive house experience, where improved building envelopes significantly reduced cooling demand. So there is a precedent to this already. And those energy savings from the operating cash inflows for our financial model. The first step was to quantify the business as usual case. Buildings in Al Wakra consume over 800 million kilowatt hours annually, with cooling accounting for 78% of demand. Using current electricity tariffs, this establishes the baseline operating cost against which project savings are measured. Applying a conservative 38% reduction in cooling loads generates a total annual energy that increases as more buildings are retrofitted. But by 2031, annual savings reach 344 million kilowatt hours, with the cumulative saving exceeding 1.6 billion. These avoided electricity costs represent the project's annual operating cash inflow and are also used to calculate the carbon reductions. Now moving on to the carbon value. Alongside the financial savings, the project avoids almost 800,000 tons of CO2 emissions over the entire program. Now, this allows us to calculate the marginal abatement cost, linking environmental performance directly to financial outcomes rather than treating sustainability as a separate objective. Now, moving on to determining the discount rate. To value the project, we estimated a project-specific cost of capital using Barwa Real Estate as the benchmark. The cost of equity was calculated using CAPM, combining Qatar's 4.74 sovereign green bond yield as the risk-free rate, a 6.5% market risk premium, and Barwa's beta of 0.65. This produced a cost of equity of approximately 9.2%. We then incorporated Barwa's capital structure with 36.7% debt financed at 6.2 adjusted for the green bond financing, resulting in a weighted average cost of capital of 7.7%. This WACC becomes the discount rate used for valuing future cash flows. Moving on to slide 7. Using the projected energy savings as annual cash inflows and the QAR of 69.5 million retrofit cost as the initial investment, we discounted future cash flows at the 7.7% WACC to calculate the project value. The model produces an IRR, meaning the project's expected return substantially exceeds this cost of capital. The payback actually occurs in year 7, indicating that invested capital is recovered before the program completely concludes. Our marginal abatement cost is at around $39 per ton of CO2, showing that the emission reductions are achieved while creating economic value through lower operating costs. Now, going back to the sensitivity of assumptions, the financial results are based on conservative assumptions. The 38% energy saving is below Barwa's observed 50% performance, while subsidized electricity suppress the value of future savings. This suggests that the model is more likely to underestimate than overestimate project returns. Going to the conclusion summary, from a finance perspective, the project satisfies the key investment criteria, and expected returns exceed the required rate of return. Capital is recovered within the investment horizon, and a carbon abatement is achieved at a cost. The analysis indicates that the thermal installation is not simply an environmental upgrade, but at the same time, this is a financially efficient capital investment. Thank you.
and my initiative is construction and demolition waste management for Al Wakra in Qatar. Right now, Qatar sends about 95% of its construction and demolition waste straight to landfills. Al Wakra has multiple large developments, all generating waste at the same time. And under business as usual, this generates about 6.8 million tons of CO2 over 25 years. That is a serious problem. Now, coming to the initiative, my initiative is a dedicated sorting and recycling facility in Al Wakra. The goal is simple. Instead of 95% going to landfills, we divert 70% through sorting and recycling. That's a 14 times improvement. The project runs for 25 years. It will abate about 4.28 million tons of CO2 and supports SDG 11, 12, and 13. On the cost side, under baseline assumptions, only 2 million Qatari riyals are spent in year one for basic landfill preparations. My initiative, however, requires 25 million Qatari riyals spread across 6 investment rounds over 25 years. The difference, the net capex, is about 22.8 Qatari riyals, which is far more than the baseline assumptions. That's what it costs to build and maintain this facility versus doing nothing. This is from the financial model. As you can see, baseline capex, initiative capex, and the net difference at the bottom, which is about 22.8 million. Now, coming for our operating expenditure for annual running costs, baseline assumption starts at about 4.5 million a year. My initiative costs more to run, but unlike the baseline, it generates two offsets every year, which is one which is recycling revenue from selling recovered steel, concrete, and etc. And the second one is energy savings. The net from the baseline and from this is about 75 million Qatari riyal over 25 years. That's the incremental cost of choosing this initiative over doing nothing. Now, the environmental impact, and this is really the whole point of this initiative. Baseline assumptions state that 6.8 million tons of CO2 will be emitted over 25 years by not doing this initiative. My initiative essentially brings that down to 2.56 million tons, and the total being abated is about 4.28 million tons. As you can see my annual abatement trend here, you can see how CO2 emissions reduce over the year from 2026 to 2050. And this is from the financial model, baseline CO2 initiative, the green abatement row at the bottom, which shows 4.28 million tons of CO2 abated across all 25 years. This is directly from the baseline. And now for WACC, for the discount rate, I used WACC, which is basically the cost of money used to fund the project. I based it on Al Barwa Real Estate Company because they're the actual developers in this region, and this is the most relevant benchmark I could use. It comes from three things. First is cost of equity, second is cost of debt, and third is greenium. All of which the rates are mentioned on the screen, and that is how I landed up at 7.85% using the formula. Now, here's a full calculation in the model, all the Barwa Real Estate Company inputs, 8-step, and the final 7.8% highlighted at the bottom. Now, let's come on to NPV and IRR. NPV comes out at negative of almost 50 million Qatari riyals. That means this initiative costs 50 million Qatari riyals more than doing nothing in today's money. But this is a public SDG infrastructure initiative. It's not supposed to really make profit. The return is environmental, not financial. Hence, this is the same reason why IRR will also be not applicable, because this is an SDG initiative and it requires at least one positive cash flow to compute. All 25 incremental cash flows are negative in my financial model, thus this is mathematically and financially correct. Now, MAC, it tells us how it basically converts the CO2 abatements in a financial to a financial monetary number. So if you convert 4.28 million tons of CO2 to dollars, it is about 6.96 US dollars abated. So this basically just tells how much you have saved in monetary terms. Now coming to the summary metrics, you can see this is the summary metrics from the model showing NPV, IRR, payback, CO2 abated, and MAC all in one place, everything calculated at 7.85% PAR. Finally, sensitivity analysis, I tested 10 discount rates to prove that this model is robust no matter what financing assumption you use. Below the base rate, 4%, 5%, or 6%, more optimistic green financing scenarios, the MAC is slightly lower. However, if you go at above the base rate, 9%, 11%, 13%, it is far more stressed and more higher, but still strong. The key takeaway is across all 10 scenarios, the MAC barely moves, and the conclusion is the same regardless of what rate you use. To wrap up, 4.28 million tons of CO2 abated over 25 years. I think this initiative, it makes sense since it is completely aligned with Qatar's national vision of 2030. Although it comes at a huge cost, but it has a huge impact on the environment, and that is a very good thing. Thank you for listening.